Greetings. Welcome back to our monthly video commentary series. I'm Nik Schuurmans, president of Pure Portfolios. We are going to dive into the most important themes for the month of May. What a month it was, despite media telling us that a recession was coming, markets were going to crash, no one wanted U.S. bonds anymore. It turned out to be the best May in 35 years for the S&P 500. So let's get into the slides. Today is Monday, June 2nd. Most of our clients will be getting this later in the week on June 5th. The rest of you will get it in our Sunday Coffee Reads newsletter on Sunday. As usual, let's do a recap of the asset classes that are most relevant to our clients. And again, if April was a difficult month, May was a blissful month. So going from the bottom up, SCHR, the blue line is intermediate term treasuries, roughly flat on the month, really nothing to see here. VNQ is a Vanguard ETF featuring REITs or real estate, modestly positive on the month. The red line gold, SGOL, again, these are all ETFs. Gold's been a juggernaut not only in 2025, but really the last few years. And for those of you that follow Sunday Coffee Reads, our blog, I just wrote about the merits of gold and the simple reason why it should have a tailwind and has had a tailwind at its back over the past few years, namely reckless government spending. It's not just a U.S. problem, it's a G7 country problem. The more reckless these governments become with their deficits year in and year out, the more of a boost or tailwind that gold and Bitcoin should have at their back, which exhibit sound money principles. If you haven't read that blog, I would encourage you to check it out. It's a very distilled and objective look at some of these emerging asset classes that should perform well with the backdrop of government debt and perpetual deficits. Moving on up our chart, SCHE, that's a ETF that features emerging markets. A big chunk of that index is China. China's had a pretty good year with their domestic equity markets, and emerging markets up almost 3.5% or a little over 3.5%. SLYV, certainly small cap values had a difficult year. It's probably one of the worst performing equity asset classes. Very focused on importing and trade, a lot of raw materials, and that's been hit by some of the tariff uncertainty. But nice to see small cap value bounce back in the month of May. CHF, this is an international ETF. One of the themes that we've been talking about, that foreign stocks should have a attractive risk return profile going forward. A lot of these stocks have trailed over the past few years. They've been out of favor. They're much cheaper from a valuation standpoint relative to US large caps. And we wrote a blog about that in early April, I believe. And then SPY is the S&P 500. Again, the best May in 35 years for the S&P 500. Oftentimes, markets don't wait for things to calm down. Markets are forward looking. You know, the economic data that we get week in and week out is backward looking. And as I alluded to during our Few Fat Pitches in Investing blog, where I talked about putting capital to work in difficult market environments is often a pretty good strategy. That turned out to be the case again. There's no all clear signal. Markets tend to bounce back when headlines are the worst, and May of 25 was no exception. The green line, that's Bitcoin. Bitcoin quietly just made an all-time high, was up almost 16% towards the end of May, had a little bit of a sell-off, profit-taking, call it whatever you want. Bitcoin has been on an absolute tear, and many folks don't equate gold and Bitcoin, but back to my blog. I'm going to say that a lot. I wrote a blog. Turns out we write about current events. I wrote a blog about the merits of Bitcoin and gold and how the two assets are more similar than different. Many people think of gold as a traditional safe haven, an inflation hedge, sound money principles. Bitcoin exhibits a lot of the same, although it is internet money. It's based on the internet. So it's new, it's emerging. There's been a lot of institutional adoption, politicians talking about it, corporations putting Bitcoin on their balance sheet, central banks buying Bitcoin. There's been a lot of developments for Bitcoin that are fast-tracked that I thought I wouldn't see in my lifetime, but it's really good to see. It's not a mature asset class yet, but it's emerging, and the folks that have been pounding the table on Bitcoin with the long-term thesis, long-term narrative, it's almost played out perfectly in real time. So I understand Bitcoin's not for everybody, but it's been an absolute juggernaut, and those that have believed in the thesis have been handsomely compensated for that. As I alluded to, the best May for stocks in 35 years. 1980 to current. You can see these blue bars on the far right is what we just went through in May. And volatility can cause people to do some crazy things. So congratulations to those investors that stuck to their long-term investment plan, that didn't panic, that were able to filter out the signal from the noise. As I always said, I said on our podcast, I've said in a few blogs, the soft data, what people were saying on social media and in person, did not jive with the hard data. The hard data, corporate earnings, retail sales, the VIX, credit spreads, equity market movements, didn't jive with the crisis levels of sentiment out there. And again, there's few fat pitches in investing. One of the best fat pitches, when you look back at 100 years of data, is putting capital to work, putting cash to work when it feels uncomfortable. That was true again, although it happened probably quicker than most people thought, but we'll take it when we can get it. Great month of May. That goes for expectations on the economy as well. If you read headlines from March or April, many people were talking about a global recession. I don't know why people still try to predict these things. The global economy is a complex system with a lot of moving parts. It's very, very hard, if not impossible, to call a recession. Governments can't do it. Hell, we can't even agree on what a recession is. However, as quickly as those recession calls came, they just as quickly left, because the Atlanta Fed takes in all the weekly economic data and they project the next quarter's GDP for the US. And those estimates have spiked. I don't know if it's people feeling less bad. I often say that price drives sentiment. A down stock market makes people feel horrible. If you feel horrible, you're less likely to go out and spend money. An up market makes people feel better. When you feel better, you're more likely to go out and spend money. So it could be that, but a lot of this price inertia is driving sentiment. Sentiment could be showing up in these numbers. And it just so happens that the Atlanta Fed GDP Now tool is now projecting robust 4% annualized growth based on second quarter estimates. So those that pound the table and make predictions, those that are pessimists, it's okay to be a pessimist, but it's also okay to change your mind. I often say it's okay to be bearish. It's not okay to stay bearish, because you're betting against one of the greatest economic engines in the history of mankind. On the theme of looking beyond the S&P 500. So this is a blog I wrote end of March, early April, that talks about the risk return profile looking much more attractive for foreign stocks, emerging market stocks, heck, pretty much any other asset class than the S&P 500. And this is a little dated. This is as of 5/23, but we're not too far off. The S&P is basically flat for the year, which you can see in the bottom right, among the worst performing equity markets in the world. Pretty much everywhere else is overwhelmingly positive. Europe is up almost 24%. Emerging markets, which China is a big component, up about 10%. And to me, this was less about the trade war. That certainly affects sentiment. That certainly can affect things if it hangs around long enough. However, heading into 2025, and I've written about this, I've talked about it before, U.S. stocks were aggressively overvalued. The margin for error was practically zero, meaning it wouldn't take much. It wouldn't take a hiccup in earnings, a trade war, another headline, a geopolitical conflict to unwind that froth. It's like a domino. You flick it and it sets off a chain reaction. That's basically what happened to U.S. stocks, because everywhere else in the world, even these countries that are at the forefront of the trade war, I mean, look at Mexico in the left column, up about 29, 30%. A lot of these countries in our crosshairs, their domestic equity markets are having blowout years. Expect that in the crosshairs of a trade war. So to me, the trade war plays a part, but a lot of it was a valuation, a setup story. The risk return profile just was much more attractive looking beyond the S&P 500. So for investors that tend to overweight what just happened was the S&P, and big tech has been a juggernaut. I would bet, I don't make predictions, but I would bet the next 10 years look a lot different than the last 10 years, and to place your bets accordingly. I'd be remiss if I didn't bring up gold. This is a price chart of gold from the start of 25 to the end of May 23rd to be precise. And I'm going to keep saying this. I did write a blog about the price movement of gold and why it's had a tailwind and it should have a tailwind going forward. And it has to do with government spending and debt. This isn't political. Our debt problem is very much a two-party problem. It started about 30 years ago, and it's unsustainable, and something needs to happen. So I'm comparing gold here in the light blue, which is going up and to the right. Gold's up about 28% on the year, versus the US dollar index. So this is an ETF that measures dollar relative to a basket of popular currencies. And you can see this gap is pretty wide. So as the dollar gets weaker relative to other paper currencies, gold has ascended higher. And people often ask me, what's going to happen over the next 3 months in markets? What's going to happen over the next 6 months? I don't know. No one knows. If someone tells you they know, run the other way. I can tell you what's not going to change in 10 years. And you can build a pretty good investment thesis based on what's not going to change in 10 years. And we can all agree, government is probably not going to get their act together and rein in these deficits, meaning tangible assets, hard assets, inflation hedges, assets that have kept up with inflation should do well. Gold certainly checks a lot of boxes on that front. I layered in Bitcoin in that conversation in that blog that I mentioned. Bitcoin, you might say, hey, Nick, it's not a tangible asset, but there's a lot of characteristics consistent with sound money principles that apply to Bitcoin and gold. If you don't know what I'm talking about, go on our website, check out that blog, A Simple Case for Gold and Bitcoin. This is a chart you all have seen before. I thought it was appropriate to update. So this is ChatGPT, the AI theme versus the internet boom, comparing the long-run arcs of both of these innovative technologies. This is the bullish case. I often talk about AI froth and overvalued tech stocks, which I don't have a problem with the tech stocks or the AI themes. I just think investors might do well to revise their expectations down, not get over their skis and crowd into those high-flying names because, as we've seen in April, it can change quickly. However, this is the optimist case, where the red line is the AI theme, and this is measured by the NASDAQ. So the vertical axis is the NASDAQ. The bottom axis is time, going from 1994 to 1999. Obviously, the AI theme is from 2022 through the end of May. But this just shows the two journeys are eerily similar. And notice it aggressively moves to the right. It's not without fits and starts. There's going to be false starts. There's going to be unwinds. There's going to be risk off where people are selling these high-flying names. But if you believe that AI should have a similar impact as the internet, there's a lot of room to run. But again, I wouldn't get carried away. I wouldn't get over your skis. Think back to, I always talk about our audience. Pure Portfolios is not a hedge fund. I'd say 80% of our clients are retired or about to retire. AI is very much a building wealth trade. It's a trade where you can seek risk, you can accept the wide range of outcomes, you can accept negative outcomes. I think retirees can do the same, but it has to be much more prudent and measured. You can't get over your skis because you don't want to take a successful plan, a successful retirement plan, layer in a bunch of risk and increase your risk of ruin. So we want to generate reasonable returns while being mindful of risk. I think AI has a place, but again, you want to be very mindful of risk management principles. So that's short and sweet. It was a blissful month, the opposite from April. Again, congratulations to those that were able to stick to their long-term investment plan. Volatility, crazy markets, headlines can cause people to do some crazy things. Filter all that out, find an objective source, a reasonable, non-biased source where you can get information. I'm going to self-promote a little bit. Our blog doesn't make predictions, but we've called a lot of the information coming in. We've distilled a lot of it to help folks make sense of it and to take emotion out of the investment process. So if you're not on Sunday Coffee Reads, you can shoot us a note and get on Sunday Coffee Reads. You'll get a weekly blog. We know a lot of our clients and prospective clients are reading current events. We're writing about current events too, but we don't have the bias and the sensationalization of what's going on. And if you have a question about how we manage drawdowns, our buy-sell framework, our risk management framework, shoot us a note at insight@pureportfolios.com. A disruptive market is a great opportunity to evaluate your portfolio. You can get some really good feedback and make some changes so you're not off the rails the next market event. One thing that I always talk about, you'd never get feedback in a bull market. You can buy all sorts of garbage in an up market and it goes up and you don't really see the warts until you get a market pullback. So we always advise people to build a sound portfolio before the next crisis happens. That way you can understand the range of outcomes. You can understand where the risk is in your portfolio, which makes it more likely to stick to your long-term investment plan. Thanks for watching. We'll see you next month.